Hey everybody, this is Professor Wei here. In this video, I want to go over some key points in the chapter of equity valuation models. Okay, so this is a very important chapter, which is mainly about one of the most important financial instruments, equity security. So I want to go over some technicals for you so that you guys might be more comfortable with the stuff you see in my lecture notes and the textbook. Okay, so let me share with you my screen. All right. So within this chapter, we will primarily talk about three major approaches to establish the value of the equity. One is the dividend discounting based valuation. So basically, we assume firms they are paying dividends under a healthy financial condition. Okay, uh, so in that case, you can think of the firm's value or equity value is going to be the uh, discounted value of future expected dividend payouts. All right. So the other alternative approach is, well, what if firms rarely pay dividends? We don't have the inputs. Well, we can use financial ratios, financial multiples, such as PE ratio or many others. Okay, actually, this is very common in the industry. The third approach is what we call the alternative DCF models. So basically, we will talk about the present value of growth opportunity approach and the free cash flow approach. Okay, outside of this scope, there is actually another very powerful method, which is developed under the notion of options. We call it contingent claim valuation framework. So you can think of the payoff structure of equity holders is basically follow a call option, right? So think about the cash flows to the bondholders versus the shareholders. So for virtually all the companies, you have to pay off the liabilities to the bondholders in the first place, right? So for being the bondholders, you actually enjoy the cash flow rights. For the equity holders, you have all the upside premium and the voting rights. Okay, so the payoff of the equity holder is virtually a form of a call option. You have limited downside, but you have unlimited upside, okay, which is an amazing deal in terms of the cash flow structure. Okay, but we'll save that to the second half of the semester. And so that's the background. And before we delve into some technical details, I want to emphasize on this seemingly basic framework, which is actually very important. Okay, so I mean, many of my former students think the valuation to be an easy job. Well, at the end of the day, it's not easy. Okay, it's actually all about figuring out all the inputs for your evaluation process. But no matter how hard it is, no matter how complex the cash flow patterns are, basically you want to use this timeline to sort out cash flow patterns in the first place. Okay, so well, one caveat is those cash flows could be time variant, and there might be a variety of risks associated with the potential cash flow patterns you are engaging, right? And to establish the appropriate rate to discount these cash flows is also challenging, okay? But at the end of the day, the valuation of the asset is the valuation of this sequence of cash flows. Okay? It's not a summation, it's not products, it's just a list of numbers. We want to list all the cash flows in the future and then discount them back to the present. That's it. Okay? So this is the structure. We want to, over the next couple of weeks, we will be exploring a variety of cash flow structures, and you will fully appreciate the spirit, of this timeline. It's extremely important to visualize the timing of cash flow, especially when you have some sort of a multiple stage of cash flow patterns when it comes to the dividend discount models for equity securities. Sometimes you have multiple stages. We have to draw the timeline to see if it's a two-stage model or deferred dividend cash flow pattern or whatever. So I mean, you just mark my words. A timeline of the cash flow is extremely important. You always want to identify the cash flow patterns in the first place. Okay. Now, okay, so on this slide, I summarize the common approaches when it comes to the valuation of the equity. Okay, DCF, market valuation approach, which is we are going to use the financial ratios, PE ratio, to establish the value. Look at the comparables, and the third one is called the option valuation. Okay, we'll save that in the second half of the semester. Okay. So, and the other thing I want to mention is we have different set of sorry, sometimes I may use different notations to capture the required rate of return. Where in your textbook, sometimes you can see the letter K. They are all the same thing. K and R. I mean, many times they often, they are used interchangeably to capture the required rate of return. Okay, or cost of capital. Okay, so I'll skip those definitions. So this is the first approach to establish the value. Simple enough. Whenever you are investing kind of an equity security, you're looking into two things. One is the dividend yield. The second is the capital gain yield, so the price appreciation. So it's actually very legitimate to assume firms always pay dividends. Okay, I know there are many firms you can argue who rarely pay dividend or never pay dividend, but at the end of the day, you have to pay back to the investors. Otherwise, it's Ponzi scheme. Okay, so well, if you believe this assumption, well, we can argue the price of the stock is nothing more than the discounted value of future expected dividend payout. Okay, well, if that's the case, all you need to do is to discount back all the future expected dividends, right? Well, the challenge is how can we find the dividend level? Okay, so the answer is we want to go back to the accounting statements to find out what is their dividend policies, what's going to be their clawback ratio, how much they're going to preserve for future growth, how much they're going to pay back for the to the investors. If we can find that number, it's not it's not going to be a huge challenge to sort out these dividend cash flows. Okay, these are public information. All right, so my point is, if we believe a firm's going to pay dividends, we can argue the price of the security is the discounted value of future dividend payouts. Okay, so all you need to do is to discount back all the future cash flows with an appropriate discount rate. That's it. Okay, now it's not going to be help us a lot if we are just using this formula, because the lifespan of a healthy company could be forever, right? You cannot just discount back all the expected dividends one by one. That's just too labor intensive. We have to use some sort of a model or a mathematic a formula to help us to do the work. All right, so the good news is we have a variety of framework that allow us to simplify the calculation process. Okay, but before jumping into that kind of arithmetic technicals, I would like to show you a big picture up front. Okay, So, like I mentioned, we always want to sort out the discounted cash flow patterns in the first place. Okay, and the other thing is we want to find out an appropriate discount rate for us to discount the value. Okay, now let's take a look. Where does the return, the required rate of return, come from? Well, it's the summation of two things: the risk-free rate plus the compensation sourced from the market risk premium. Okay, so the risk-free rate is quite straightforward. It's just nothing more than the return on the 3-month treasury bill rate or 1-month treasury bill rate, whatever. So it captures the return for the risk-free component. Okay, and the other thing is for whatever portfolio or stock you are looking at, well, you are going to be compensated for the fact that you are bearing the market systematic risk. Okay, and the beta you see on the screen is what we call the market sensitivity. Okay, if the market risk premium changed by 1 unit, your expected return is changed by a unit. Okay, we'll talk about that later. This is known as the capital asset pricing model, so that it basically tells you that your expected return can be decomposed into two components. One is the risk-free rate, one is the market risk premium. Well, you may ask me, where is the firm-specific component, the idiosyncratic risk? Well, it's fully diversified. By forming a portfolio, you can diversify your firm-specific risk. What is firm-specific risk? Well, it is unique to this particular firm, right? For example, the CEO of this company is trapped into whatever sort of a scandal. This is type of a news specifically applied to this kind of a foreign firm, right? Or for on the other end of the spectrum, if you are looking at the market-wide news, for example, we have been talking about the rising interest rates and the geopolitical uncertainty or post-pandemic recession. These are the market-wide information. Okay, you are only compensated by bearing this sort of a market risk premium as opposed to firm idiosyncratic risk, because by forming portfolio, you can fully hedge this kind of firm-specific risk. But anyhow, that's where the cost of equity kicks in. Okay, so basically, it's a form of it's a function of a risk-free rate and the market risk premium. The return to the investor is the cost to the firm. That's one way to interpret the cost of equity. We are going to use that cost of equity to discount back all these future expected dividend payouts. Okay, where does the dividend payout come from? Well, we want to go back to the income statements to find out their net income and the payout ratio so that we can determine the dividend level, right? It's not very hard. And once we sort out these inputs, we can use the formula on the screen or other forms of formulas on the screen to discount back your future expected dividends. Okay, so this is one form of dividend pattern. So it's constant. This is what we call the preferred stock. Right, so it's pre-specified at a certain level and it lasts forever. We are going to use the perpetuity formula to determine the value of the preferred stock. And on the bottom of on the second half of the on the bottom half of the screen, you can see we have a case 2. We call it a constant growth growing perpetuity. This is also named as Gordon dividend growth model, so that it captures the ideas where in a healthy financial condition, firms constantly paying a constant growth growing dividends. Okay, so you're going to constantly pay back to the investors with growing dividends. Okay, so if that's the case, your price will be a ratio of two things: your dividend next period over the difference between required rate of return and the growth growth rate. Okay. On the canvas, I posted a standalone short notes containing the detailed derivations of those formulas. If you're interested in that, you're more than welcome to take a look, but that's not something required. Okay. What else? So the other thing I want to show you is, I believe you guys learned this thing before. This is called growing annuity and the growing perpetuity. Okay, so this is the perpetuity form I just showed you on the last slide, and this is growing annuity. The difference is it's finite. Okay, so the horizon is determined, whereas for the growing perpetuity, it lasts forever. So this is the formula for growing annuity. You don't need to be responsible to memorize that. You can use Excel or any other forms of platforms to do the computation. Okay, again, you are not required to memorize this kind of formula. I don't even remember that. So I mean, it doesn't hurt your performance but you have to be able to identify the cash flow pattern. Okay, so this is how it looks like. I mean, the intuition behind the scene. So on case 3, basically it tells you we have 2 stages. Well, you think about this. On early stage, for whatever company, when it is still at the baby stage, the cash flows pattern may not be very stable. It's kind of a volatile and variable. So you can see it's changing over time on the initial growth period. Right? And after, I mean, when it comes to the constant growth stage or enter to the second stage, it's growing constantly over time at a very stable growth rate, or we call it sustainable growth rate. Okay, so if the first stage is kind of a, if there's no pattern at all, we call it variable growth rate. Variable growth model. We want to discount back all these cash flows one by one, period by period, to the present, and sum them up. That's the present value of the first stage dividend payout. Excuse me. On the second stage, you have a growing perpetuity, so that you can use that Gordon growth model to discount back your second half of the cash flow to the present. Okay, so basically, let me see. Let me reshare my screen. I want to give you an example. Hold on. So on the screen, you can see in Excel, you have a 2-stage model. Where on the first stage, you have 20% growth rate. Second stage, you have 5% growth rate. This is what we call the 2-stage growth model. So basically, the idea is that on the first stage, the startup or whatever small company is growing at a super fast growth rate because they plow back everything for future growth. After a couple of years, because of the market competition, while the growth rate is driven down from 20% to 5%, now what you are going to do is to establish the value of the cash flows on the second stage. So basically, you are going to discount back all the future cash flows on the second stage to the ending point of the first stage. Okay, let me repeat that again. You are going to discount back all the future expected cash flows on the second stage to the ending point of the first stage. Okay, so what you are going to do is to use the Gordon dividend growth model. So D1, divide the difference by divided by the difference between the required rate of return and the growth rate. And so this $43 is what we call the terminal value. And then we are going to discount back all the first stage cash flows, and along with the terminal value, so we are going to discount back all the first stage dividends along with the terminal value to the present. We call that number to be the stock price. Okay. All right, so that's the idea entailed by this graph. Okay. I did post the Excel on the canvas. You're more than welcome to pause the video and revisit the example. So I do like this, kind of a diagram. It sort the universe into a 2 by 2 dimension space. So you have the perpetuity, annuity, you have constant cash flow and growing cash flow, so that you have constant perpetuity and constant annuity, as well as the growing perpetuity and growing annuity. Okay, so there are 4 different types. Now on my slides, there's another form of stock. On the first stage, you have a non-constant growth, so discount back every single one of them to the present. And on the second half of the stage, on the second stage, you have a constant growth dividend payout, so that you can use Gordon dividend growth model discount back all the second stage cash flows to the present, and then discounted back the terminal value to T0, sum them up, that gives you the stock price. Okay, so you're more than welcome to follow my step-by-step instructions. So this graph captures the spirit of 2-stage growth model, driven by the market competition. Well, the growth rate usually turn out to be, the magnitude will be smaller on the steady state growth stage. Okay. Well, that's basically the same thing. So there is another thing I want to talk about, and that is the determinants of the dividend payout. So we want to introduce you one thing, and that is the clawback ratio, which is the addition to retained earnings scaled by net income, and that is equivalent to the difference between 1 and the payout ratio. So all of the dividend payout, how much you are going to preserve for future growth. So how to determine the payout ratio? Well, that's the dividends divided by the net income, right? So you can extract all this information from your income statement and the balance sheets. Okay. Well, the sustainable growth rate is determined by the product of return on equity and the clawback ratio. So essentially, ROE times 1 minus the payout ratio. In this course, you are not responsible for the second type of the growth rate, but it's good to know there are 2 different types of the calculation determined upon the equity form, whether it's the beginning equity or the ending equity. Okay, so beginning equity at the addition to return earning is equivalent to ending equity. So that's how it works. But it's not very fancy. Just kind of depending on the scenario. Let's just simplify the process. We are going to follow the beginning equity form. All right. So I have a couple of examples over there. It's just nothing more than the number crunching, very straightforward. The required rate of return is nothing more than a summation of capital gain yield and dividend yield. You can just play around with using these formulas.